What's up, people? It's Kenneth here, streamhomeloan.com, 100 years of wealth. I hope your day is going well. As you can see, I'm using Zoom to shoot this video just so I could, because I was having trouble getting my lighting right. So I'm using Zoom, I'm blurring out my little background, but I wanted to make sure I stayed on it, made the content for you because I do think that this is valuable, and I think it continues to help people out there kind of discover that they can actually purchase a home right now. So my belief is that, and this isn't just a belief, this is a proven fact that most of the wealth that's ever been built in this country has been built through home ownership, right? Like your traditional, normal middle class person, and even your higher net worth individuals, it's been proven that buying a home is, or let me take that back. At least for your normal middle range or middle class. I really don't like class type stuff, but you get what I'm saying. Like the middle income, middle class, working class of people in the country have been able to build wealth, pass it down generationally through ownership in real estate. It's been the most secure asset over time, right? There's no property right now that is worth less than it was 20 years ago. It's just not, it's not out there unless you're even in like a place like maybe Detroit, which had like a big shutdown in their economy because of the auto industry. I still would think that that holds true there. So overall, you know, owning a property is definitely going to be a great step in the direction of building your individual wealth, and then also being able to pass something down to your next generation. So I say harping on that because I think it's very important. I bought way later than I should have. I bought a home when I was like 34, 35 years old, when I had been working since I was 21 in the mortgage industry, in the real estate industry, and I still hadn't bought a home. It was probably because I just, like, at the time that I did initially look way back in the day, I was looking at something that was affordable for the moment, but probably not like a wise decision to get into. I ended up not buying. But you end up renting apartments, and I think because like you're growing in life and so much stuff is going on, unless you have someone a little bit more mature than you that has a little bit of foresight, um, to push you and say, hey, no, you should really be trying to focus on buying something right now. A lot of times we just rent and move from rent situation to rent situation. We're like, ooh, cool new apartment, and stuff like that, as opposed to being like, nope, I'm gonna find me the cheapest house I can get into or the most affordable house I can get into and start building some equity. Because when you're 25, if you did that, you bought something at 25, you look up at 30, you're going to be way ahead of the game. You're going to be putting yourself in a way better position. Even if that property is something you end up wanting to sell, you will likely have a good chunk of equity, making it an easier move going into the next property. So that's why it's very important for people to understand, hey, look, if you can afford your monthly expenses or whatever monthly expense you're pre-approved for on a home purchase, once again, if you can afford it, do it. Unless you have some big other plan that you want to keep your income away from a mortgage to invest in a business or something like that, by all means. I still think that it's a wise decision that if you have the consistent income coming in, to be paying a mortgage, gaining equity instead of renting. I think we all know that, but everyone's situation is a little different. Sometimes people are in transition, they have plans that make it to where it doesn't make sense to kind of like put down roots in one place. But I don't know. A lot of times it still makes sense. Like if you were like, hey, well, I'm going to be leaving the country for 6 months. All right, well, cool. Then take that property, Airbnb it, cover the mortgage payment, make a little income. But once again, every situation is a little different. I always want to respect that. But what I wanted to touch on was just the basic factors that it takes right now to get into a property. I've made a video before talking about 100% down payment. So I want to reiterate that right now, there are loan programs available that only require you to put down, or sorry, that only require a credit score of 580, and you are able to qualify for 100% financing, right? So FHA, Federal Housing Administration, they have their minimum credit score requirement for going up to 96.5% loan to value is 580. So under FHA guidelines, you would be able to get 96.5% of the purchase price finance as long as you have a 580 FICO score. Multiple lenders that I'm working with right now are doing a down payment assistance right behind that first mortgage FHA loan, and they are giving you an additional 3.5%. So it's covering the full purchase price of the property. So you don't have to bring anything down, and you have 100% financing. And then on the other side of that is, this is more on the real estate side, but depending on what property you purchase and depending on your real estate agent's negotiating skills, a lot of times sellers right now are offering credits towards your closing costs. I just closed a transaction where the builder on the property was giving my client $20,000 in credits towards closing costs, just because they want them to close by a certain date. We were able to meet the number, gave our clients $20,000 and literally covered all their closing costs. So in that scenario, my client literally maybe had a few $100s out of pocket. But back to the parameters. So 580 middle FICO, not the lowest credit score, not the highest. So you have three bureaus: Equifax, Trench Union, Experian. They're looking for the one in the middle. 2 years employment history, right? Like standard FHA loans are going to be looking for 2 years employment history. Sometimes you can get approved on a loan scenario that only requires you to provide 1 year W-2s or 1 year tax returns. So 2 year employment history. If you've been in your line of work for at least 2 years, you can likely qualify for a loan, depending on your income, your expenses, stuff like that. Debt ratio. So you have your credit, right? Like you have your income scenario, your employment history. So you have the 2 years in the industry. Even if that 2 years is a patchwork of different companies, if it's in the same line of work, they'll give you credit for that time frame. And sometimes, if there's like a slight difference, like, oh, I was in retail and I was a general manager, and now I'm in retail and now I'm in the sales department, you can have a slight change in title, as long as you're in like generally like the same line of work. If there's a drastic change in your line of work, it does start to look like there's less consistency, and it brings into question, what's your likelihood of working in this line of work in 6 months? Are we going to lend you this money and then you're going to be in a whole different line of work where we don't know what you know what I mean? Like the stability changes, so that's a factor for lenders. So you got your credit, right? You got your employment history, right? So if you have the employment history, the next step is, what is your income and how does that apply to your debts that you have? And that's when you come up with a debt ratio. So with the FHA, they're allowing your back end debt ratio to go as high as 56%. So it's a little bit higher. It's like 56.99%. But basically that means that, if just for easy numbers, if your income's about $10,000 a month before taxes, they will allow your mortgage payment, including your property taxes and insurance, along with your other monthly expenses that show up on your credit report, to total up to be $5,600 or less, roughly 56%. That's your back end debt ratio. Okay, your front end debt ratio can be up to 46.99%. Front end is only going to include your housing expense, your mortgage, taxes, and insurance. Right. So keep that in mind. It's an easy number to kind of figure out. So if you're at home and you're like, hey, my income's $5,000, what's the max payment that I can afford or qualify for? Multiply that 5,000, go on your calculator, 5,000 times point. Let's do it on this calculator. See if I can get it in for you. All right. So we got, my income's $5,000 a month times, it's all backwards, times, so you would go 46.99. Wait a minute. 5,000 times point. It's 2,399 would represent. Yeah, $2,399 would represent what 46% is of 5,000. I think. Let me just double check my math because I was a little off there. 5,000. Yeah, roughly 2,399, right? So if you make 5K a month, you're going to multiply that by 0.47, or sorry, 4699. That's going to give you 46.99% of your income number, and that'll tell you what the maximum is for your mortgage payment, right? So that's good to know, because in that way you can look and say, okay, you know what? they would likely qualify me for this. I am comfortable with a payment like that. Let me explore this further. Okay, so back to the little track we got. Credit score 580 minimum will get you into 100% financing. You got 2 years employment history in the same line of work or similar line of work, that's going to cover it. Your debt to income ratio, your expenses compared to your income are less than 46.99% on the front end, meaning your mortgage payment, housing payment, like your taxes and insurance included. And then on the back end, your mortgage payment and your other expenses that show up on your credit report can be as high as 56.99%. Okay. And then we already covered the down payment side of it, 100% financing. So you're not going to have to come out of pocket with any money. Now, the other side of it is that if a seller is going to give you a credit for closing costs, then, depending on what that is, that'll determine how much you have to come out of pocket on your own. Generally speaking, you're going to have closing costs, standard fees of somewhere around the $3,500 to $5,000 mark, depending on county, depending on escrow charges, title, things like that. Depending on if there's any points associated with your rate, things like that. And then you have your prepaid taxes and insurance, which is a buildup for your. It's basically building up taxes and insurance in an escrow account so that it can be paid out throughout different installments throughout the year. And in these scenarios, you are going to be required to include your property taxes and insurance into your mortgage payment. So, if you don't have any credit coming from a seller or the lender is not offering some sort of credit for your closing costs, then you probably, like in a scenario let's say a loan of around 400, 500,000, you're probably going to want to have ten to $15,000 set aside for your closing costs, right? But there are a lot of scenarios right now where lenders do offer credits depending on the rate that's being selected. But there's a lot of scenarios right now where sellers, because the market is a little bit slower and it is hard to get their property sold at the price that they want, they're going to offer the incentive of giving some sort of credit towards your closing costs. So, but if they aren't, you probably want to have 2 to 3% of the purchase price in a bank account for your closing costs. So if it's a $500,000 purchase price, you're probably looking at 10 to 15K, and not just closing fees, but closing expenses, your settlement charges, your taxes, your insurance, your prepaid interest. These are things that aren't charges from the lender, but they are, part of the settlement of your transaction. So if you're sitting around and you got like $20,000 in your bank account, and you're like, hey, I know my credit score is above 580, maybe it's 600 or so, maybe 620, maybe even higher. You're like, hey, I'm making 6, 7, 8K a month. My expenses are pretty low. Maybe I can qualify for a home. You know, I would say it would be a good thing to do just so you could see what it is and see what your payment would be, and then you can look on Zillow, Redfin, and see what's available for that price range. It might be the first step of a really smart decision, because one thing I will say about home ownership is that it's the one asset you could buy and through your own efforts increase the value of that asset, right? Like if you buy a stock, it is completely out of your control with that, what happens to the value of that stock, right? If you buy jewelry, the jewelry, it is what it is. It's not going to change. The market will fluctuate around that. If you buy a piece of property, let's say you buy a property and the curb appeal on the property isn't what it could be when you purchase it. I bought a house in Windsor Hills. This is like a little unincorporated area of Los Angeles. Bought a house 2020. It was right when COVID was peaking, when that property came on the market, like March 13th or so is when it got on the market. That was like literally one of the big days when COVID was starting to take off, and there was a lot of like fear and wondering what the hell was going to happen. So that started making that property value drop. And on top of that, the property needed some, cosmetic repairs, basic stuff. Like some of the stucco was damaged, the roof shingles were kind of beat up, lawn needed to be mowed and maintained. But those little things allowed me to get in at a very, what I considered a discounted rate. And shortly after we purchased the home and we did some of our own repairs, We were able to refinance, got a very, much higher estimated value. And and that was with us putting very little money into the property, but it was more the cosmetic repairs that we did that created a whole different visual look on the property. You have to remember, a lot of times when people are buying homes, there's a lot of people that don't have any DIY skills, that don't have any like visual vision on how they can improve a property, or know how to do it without, spending tons of money. So if you have that ability, or that ability to kind of see, okay, like, hey, I think I could touch this property up with some paint. If we get that lawn in order, then blah 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 blah, you can really increase the property value, you know significantly, because the difference between a property that'll sell for let's say it was 775,000, and it had all the cosmetic issues, and now the property appraises for like 1 point, or estimated value is like 1.1. That's with just some basic cosmetic stuff, right? But your average person that's looking at that property is like, ugh, it's beat. I don't want it. What's wrong with the stucco? Why is it like that? Maybe there's more wrong with it inside, really. But me, I'm like, shit, stucco, that's easy. That's light work. I could probably do that myself, but I had a professional do it. But you get what I'm saying? So I really think that the main thing that we should be preaching to young people that are out there working is grab a piece of property, not the nicest property, not the worst, right? Like, you don't want like a hellhole, but find something where you can put a little sweat equity into it and create that additional equity. That's going to give you the opportunity, when rates are a little better, to refinance out of the higher interest rate scenario that you got into because you weren't putting money down, give you an ability to pay off that down payment assistance portion of your financing, and make your financial life better. Right? When I bought a home, that allowed us to, improve the home, got a higher value. And when we got the higher value, we refinanced, took some cash, paid off some debt, helped our credit scores improve, helped our overall cash flow. Took a little cash out, put it in the bank. You start to be able to like build reserves, and keep your overall monthly debt load low. And you have your, most of your debt is attached to your property, and you have ability to write off mortgage interest. So there's a lot of different benefits that come up once you own a property. And then, like that first property I was just talking about, when we moved to the property that we found during COVID, we rented that other property out. And we had someone staying there for a good year and a half, basically paying that mortgage. We're making a little money on top of it. And then when we ended up selling that property, we made a really big chunk of money. We were able to avoid capital gains because it was previously a primary residence for us. But overall, properties have been the key to me and my wife gaining financially. So just want to share that gem with you. I hope you guys are doing well. Please stop, like, subscribe. 100 years of wealth to you and yours. Stay up, folks. Hey, and go Lakers.